All right, I promised you at the beginning we were going to talk about the SPIVA report. SPIVA, S-P-I-V-A. This is basically the S&P and Dow Jones index people. And they do a report each year. Actually, they do it twice a year that talks about how mutual funds have done against their respective index. Okay, so an index like the S&P 500 index is the returns of the, essentially, it's not exactly this, but essentially the 500 biggest companies in the United States. So it's a large cap stock index. Large cap means the big companies, the ones you've heard of, the Apples and the Exxons and those sorts of companies. So that's the S&P 500 index. And if you take a mutual fund that invests in large cap stocks, it would be appropriate to compare it to the S&P 500 index. And so that's an index, right? And, the surprising thing to a lot of people, if they've never looked at this sort of data before, is that the professionals, the people who do this all day long, who are experts, who have degrees in finance and have an army of analysts that go out and analyze companies, that the professionals on average do not beat the indices. The return lags the index on average by about the amount of their expenses. Multiple studies, the one I'm most familiar with was over 32 years, found that the average mutual fund trailed its index by 1.8% per year. And so it's a little bit depressing that way to realize you can't beat the market, especially when it's so easy to get the market return just by buying a low-cost, broadly diversified index fund. But anyway, the most recent data is out. And when you look at all U.S. funds, you will see that last year, only about half of them beat the index. Well, that's pretty good. Half of them beat the index. That's great. 50-50 proposition last year if you look at all U.S. funds. However, as time goes on, it turns out there's very little persistence in which actively managed funds beat the index. So after 3 years, 79%, not 50%, 79% of the actively managed funds underperformed the index. After 5 years, it's 88%. After 10 years, it's 93%. After 15 years, it's 94%. And at 20 years, it's 92%. So you can take a chance over your investment horizon that you're going to be able to pick that 8 out of 100 mutual funds, that 1 out of 10 essentially, that's going to beat the index. Or you can take the sure thing and just buy the index fund that essentially guarantees you the market return. That's not a bet I'm willing to take, a 10% chance of beating the index. And this is all before tax. If you're investing in a taxable account, it's even worse once you apply taxes because index funds are so tax efficient. And it's not really a different story for any of the other asset classes. If you go down their 20-year column, you'll see for large cap funds, 95% underperform the index. For mid caps, it's 94. Small caps, 94. Large cap growth, 98. Large cap value, 87. Mid cap growth, 92. Mid cap value, 92%. Small cap growth funds, 97% underperformed an index fund. Small cap value, 92%. Right? Real estate funds, it's 87%. It just goes on and on and on and on and on. It's really depressing to see what a poor job these mutual fund managers are doing. And, when you look on the bond side as well, it's not as impressive of data, but the story's the same. As the time period goes out longer and longer, the index funds outperform. So the message you should take from that is that not that stocks are a bad investment. Stocks are a great investment. These are the world's most profitable companies in the history of the world. No companies have made profits like the companies in the publicly traded stock market are making today. It's like Elon Musk likes to say, people accuse him of not paying taxes. And he points out, I paid more taxes than anybody else ever has in the history of the world. And it's true because these companies are the most profitable things there have ever been. So investing in them is a good thing. However, how you invest matters. Going out and just buying a few individual stocks is a mistake. You're taking on uncompensated risk. If a risk can be diversified away, you should not expect to be compensated for taking it. And when it comes to individual stock risk, that risk is easily diversified away by using mutual funds. Another risk people run is manager risk, and that's the risk that your manager underperforms the index. And as the SPIVA report demonstrates quite well, that risk is very high. You've got a 90% chance over a 20-year time period that your selected mutual fund is going to underperform an index fund. And so you don't have to do that. You can just invest in index funds. It's beautiful. No manager risk, no uncompensated stock risk. You can just disappear for a couple of years and not even look at your returns and know that you're still going to be getting the market return. Now, the market return might be negative 1 year. It's negative on average about 1 out of 3 years. So it's not unusual to lose money in index funds. But in comparison to picking your own stocks, in comparison to picking your own mutual fund managers, you're generally going to do better with index funds. And over the long term, the market is going to provide not only positive, but solid returns that are going to help your money to grow, to help your money do some of the heavy lifting of reaching your goals. So invest in stocks, use index funds to do it. That's the bottom line.
The hosts of the White Coat Investor podcast are not licensed accountants, attorneys, or financial advisors. This podcast is free entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.